Hello, welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which relied upon as any form of personal advice. FP Markets does not know your personal scenario, nor your personal financial goals, and therefore none of which relied upon as any form of advice at all. Is just general in nature only. June is going to be, in my view, an absolute blast. It is going to be a big mid-year setup for the rest of 2022 and probably also the start of 2023. There are so many central bank differentials to play out in terms of where we sit. You have got the Bank of Canada, the Bank of England, the Reserve Bank of Australia, and the Fed all expected to raise rates in this current month. The Bank of New Zealand's already done it. And who would have thought that sometime in the next month or two, even the ECB might join in that party as well. I need to highlight this. Stagflation is a real possibility towards the back end of the year. It's not happening yet, and I think that needs to be pointed out. It's not happening right now. At the moment, don't forget the definition of stagflation is high in inflation. Clearly that's a tick, we've got that, but also low growth and high unemployment. Definitely don't have high unemployment. We've got 48-year lows in Australia, roughly the same in the States, and in Europe and the UK, they're doing quite well as well. But that can unwind when you start to look at the fact that growth is the thing to watch. And this week, you get the Australian GDP figures to go with what happened last week in the US for the second read of their GDP. And then you get the rest of the world coming out the week after. GDP for the first quarter is now showing real signs that the impact of costs from inflation has come faster than expected and was probably actually taking hold in the start of this year rather than starting in the last 5 to 6 weeks, which is I think most people see in that space. Have a look at the construction and capex numbers from Australia. They were really negative in terms of where they were, complete reversals of what the consensus figures. You then have a look also at things like inventory in the States and the cost and price items in the States. They're really high. And that therefore is going to start bringing in the idea that the second part of stagflation could come into actually being a tick as well, which means the third one, and the one that's always last, is employment. And employment is always that final barometer to understand because it's always a slow moving ship. And normally when you start getting the kind of scenarios we've got with stagflation, it's unfortunately the bottom end of the society that tends to feel it the most. And that's where you're going to see a lot of this pain coming through. What does that all mean for FX? And that in the end is what we're here to do. It is still all around that bank differential. Who's going hardest? Who's front loading? Who's going to be the one that actually continues on the current fight of inflation over everything else? And you'd have to probably highlight, probably in where it currently sits, the Bank of England, the Reserve Bank of Australia is not. The Reserve Bank of New Zealand is. The BOC probably is. And then you've got the Fed, and they definitely are. And the Fed, I think, still wins in terms of how it is, and the US dollar continues to show that. Although it has eased, as we've been talking about for the last couple of weeks, as expected, overall, it hasn't eased anywhere near the kind of level of things we're really reversing away from that differential. And in the main, the Fed is telling you they're going to go hard and fast, and that's what you'd expect to see in June in their upcoming meeting in a couple of weeks' time.